I honestly wasn't planning to record today, but then something happened that completely changed my mind. Oil didn't just move up a little. It surged past $115 a barrel. And almost at the same moment, Bank of America released a research report that wasn't meant for people like you or me. It was written for institutional investors, hedge funds, the big money on Wall Street. And what that report says matters a lot because it quietly explains what the smartest money in the market is preparing to do next. So even though today was supposed to be a quiet day, I looked at Winston and thought, people need to hear this because you deserve access to the same insights the big players get behind closed doors. Now, Winston is already getting restless on the sofa. He probably heard a rumor about snacks somewhere in the house. But stay with me here because this situation is serious. When oil reaches levels like this, it should make investors nervous, not because it always means disaster, but because history shows a very clear pattern. Every time oil has spiked sharply over the past 50 years, a market crash followed shortly after. And I don't mean sometimes, I mean every single time. 1973, 1979, 1990, 2008. Each of those moments started with energy prices jumping rapidly, and soon after, markets broke down. What makes this moment even more confusing is that assets that are supposed to protect investors during crises are falling too. Gold has dropped significantly, and silver has fallen even harder. Instead of one area of the market collapsing while another offers safety, it looks more like everything is falling at once. That kind of environment leaves most investors unsure about what comes next. They feel the tension, but don't fully understand the pattern forming underneath the surface. So over the next few minutes, Winston and I are going to walk through what is happening step by step and explain why Wall Street is quietly positioning itself while television networks continue telling everyone to stay calm. For those who may not know us, my name is Felix. Winston is right here beside me, even though he refuses to sit still. Before founding our education platform years ago, I worked as an investment banker and economist. After stepping away from that world, we started sharing the kind of knowledge that usually stays inside large financial institutions. Our goal has always been simple: help regular investors understand how professional money moves through markets. And right now, the signals I'm seeing in commodities and financial data look very familiar. This pattern has appeared before many times. You probably already know what triggered the current chaos. The conflict involving Iran and the disruption around the Strait of Hormuz has had a massive impact on global energy flows. Over the past month, oil shipments moving through that narrow passage have dropped dramatically. We're talking about roughly 70% of the usual volume disappearing almost overnight. That equals around 5 million barrels of oil per day, no longer reaching global markets. This is not a small interruption or a temporary inconvenience. It is a real supply shock, and the last time we experienced something similar on this scale was back in the early 1970s. Right now, if you look at the official market price, Brent crude futures are trading slightly above $113 per barrel. That's the number most headlines repeat. But there is something important the mainstream coverage isn't discussing. The price being paid for actual physical oil shipments heading toward Asia is far higher. In some deals, it has climbed above $150. When the real world price of a commodity separates from the paper price trading in financial markets, it usually means supply is much tighter than investors believe. In other words, the market may still be in denial about how serious the shortage actually is. The Federal Reserve has already modeled different scenarios based on oil prices. In a mild scenario, oil would sit around $98. That level has already been passed. Their base case assumed prices around $115, which is where the paper market roughly sits now. But the severe scenario predicted a major global slowdown if oil reached about $130 per barrel. Yet in the physical market, the real world price has already moved well beyond that. If most investors didn't know that until now, it shows how easy it is for critical information to remain hidden behind simplified headlines. Before we dive deeper into how this pattern works, I want to explain why this matters so much. Wall Street isn't reacting randomly. Large institutions study decades of market behavior, and when certain signals appear together, they adjust their strategies quickly. The research note from Bank of America outlines where professional investors believe opportunities could appear during a crisis like this. Most retail investors never get access to those notes because they are written exclusively for major clients managing enormous pools of capital. But understanding their thinking can help us see where money might move next. To understand what may happen now, it helps to look at history again. In 1973, oil prices jumped from about $3 per barrel to roughly $11 in a short period of time. That surge triggered economic stress across the world. Soon after, the S&P 500 fell nearly 50%. Investors experienced one of the most painful downturns in modern market history. Later in the decade, another shock arrived during the Iranian Revolution. Oil rose sharply again, inflation surged to extreme levels, and interest rates climbed toward 19%. That environment pushed economies into deep recession and forced governments to react. And history kept repeating the same pattern. During the 1990 Gulf War, energy prices spiked once more. The stock market dropped significantly as uncertainty spread across global markets. A few years later, in the late 1990s, oil prices quietly tripled again. What followed was the collapse of the technology bubble, which erased huge amounts of wealth and took years for markets to recover from. Then came 2008, when oil climbed rapidly toward $147 just before the global financial crisis erupted. Each time, energy acted like an early warning signal. It revealed pressure building somewhere in the economic system long before most people noticed. That's why watching oil closely right now matters so much, because what we're seeing today looks very similar to the early stages of those past cycles. The difference is that many investors still believe this situation will resolve quickly, but structural disruptions in energy supply rarely fix themselves overnight. And that brings us to the mechanism behind these crashes, because oil doesn't break markets directly. Instead, it starts a chain reaction that spreads through the economy like falling dominoes. The first domino is transportation. When energy prices rise sharply, the cost of moving goods increases immediately. Ships, trucks, airplanes, delivery networks, everything becomes more expensive to operate. We're already seeing diesel prices jump rapidly, which means companies that rely on transportation are facing rising costs almost instantly. Once that happens, the second domino falls. Businesses that produce goods start paying more for the materials and energy needed to manufacture products. Oil isn't just fuel. It's a key ingredient in plastics, chemicals, fertilizers, packaging, and countless industrial processes. As those costs climb, companies are forced to raise prices to protect their margins. That leads directly to the third domino, which is where consumers finally feel the pressure. Grocery bills rise, shipping costs increase, and everyday purchases become noticeably more expensive. When inflation begins climbing again, the fourth domino involves central banks. The Federal Reserve suddenly loses flexibility. Investors had been expecting multiple interest rate cuts this year, believing the economy would gradually cool down. But if energy-driven inflation keeps rising, the Fed may not cut rates at all. In fact, markets have already started considering the possibility of rate increases instead of reductions. That shift changes financial conditions across the entire economy. As borrowing costs remain high, consumer confidence weakens, spending slows down, businesses become cautious, job markets start showing signs of strain. One by one, each domino moves into place, creating the kind of environment that often leads to major market volatility. And right now, almost every one of those signals is beginning to appear at the same time. That's why investors need to understand what may come next, especially because something unusual is happening with gold during this crisis. Normally, when uncertainty rises and markets become unstable, gold performs well as a safe haven asset. But this time, gold has been falling instead of rising. That confuses many investors, but there are several reasons behind it. One of them involves the new Federal Reserve leadership, which appears far more focused on controlling inflation than stimulating markets. Higher interest rates increase the appeal of bonds, since they provide income, while gold does not generate yield. As a result, some investors temporarily move away from precious metals. At the same time, the US dollar has strengthened in global markets. When the dollar rises, commodities like gold often struggle because they become more expensive for international buyers. Meanwhile, technology stocks and other major sectors have also been declining, creating what looks more like a broad market reset rather than a single asset crash. When multiple areas of the market fall together, investors often panic and rush toward whatever they believe is safest in that moment. This leads us to a concept many people overlook, but is extremely important in the current environment. That concept is stagflation. It sounds technical, but the idea is actually simple. Stagflation happens when inflation continues rising while economic growth slows down at the same time. That combination creates a difficult situation for policymakers because the usual tools no longer work effectively. Cutting interest rates could worsen inflation, while raising rates could push the economy into deeper contraction. In situations like that, central banks become limited in what they can do. And that brings us back to the research report I mentioned at the beginning of this video. According to Bank of America's analysis, there's a possibility that governments and central banks may eventually step in with emergency policies to stabilize markets. They call this a policy panic, which means intervention could arrive suddenly once markets reach certain stress levels. And if that happens, the consequences for currencies, commodities, and global stocks could be significant. Because when governments react under pressure, money often begins moving quickly between different sectors of the market. That is exactly the kind of moment professional investors prepare for in advance, while most retail investors are still trying to understand what is happening. And understanding that shift is critical because the next stage of this cycle depends on how policymakers respond once markets reach those trigger levels. If intervention begins, the dollar could weaken again, which would completely change the direction of several major assets. In fact, the report suggests that once confidence in the dollar starts fading, two areas of the market may quickly regain leadership: gold and international stocks. And this is where the story starts getting even more interesting, because the recent sell-off in gold might not mean the trend is over. Instead, it could represent something very different, something that very few investors are paying attention to right now. The current decline might actually be creating the kind of opportunity that only appears during periods of extreme uncertainty, when sentiment across markets reaches its lowest point and most people are convinced things will continue falling. But before we jump to conclusions about that possibility, there is another factor shaping the global financial picture, a factor that could influence how investors view the United States itself and how capital moves between countries over the coming months. Because if geopolitical tensions continue longer than expected, confidence in leadership decisions could start shifting in ways markets rarely anticipate. And that shift could affect far more than just oil prices or commodity markets. It could reshape how investors think about the entire global financial system, which brings us to the next part of this story. Because once confidence in leadership begins to shift, markets start reacting in ways that are not always obvious at first. One of the points raised in the Bank of America research note is that prolonged geopolitical conflict can slowly weaken the perception that the United States has full control over global outcomes. That perception, whether people realize it or not, plays a major role in why U.S. markets trade at premium valuations compared to many other countries. Investors believe the system is stable, predictable, and capable of responding quickly when problems appear. But when a conflict drags on longer than expected and disrupts something as important as global energy supply, that belief can start to crack. If the situation involving Iran becomes more complicated and difficult to resolve, it may reduce confidence in the ability of policymakers to stabilize the environment quickly. That matters because global investors allocate capital based not only on economic data, but also on trust in leadership and institutions. If that trust weakens even slightly, money begins looking for alternatives. Over the past year, we have already seen subtle signs of this happening as the dollar experienced periods of weakness while investors explored opportunities outside the United States. And according to the interpretation of this research report, that trend could accelerate if the crisis continues. When the dollar weakens, several things typically happen across financial markets. Commodities often perform better because they are priced in dollars, making them cheaper for international buyers when the currency loses value. Gold tends to benefit as well because investors begin looking for assets that preserve purchasing power when confidence in currency strength declines. International stocks, especially in regions less affected by the conflict, can also attract capital as investors diversify away from U.S. markets. That mechanical shift in capital flows is something professional investors watch closely. Now, this does not mean the United States suddenly becomes an unattractive investment destination, but it does mean the balance of global capital can change more quickly than most people expect. The research note suggests that once the dollar begins weakening again, sectors outside the U.S. could regain leadership in the market cycle. That includes international equities and certain commodities that have recently been under pressure. And interestingly, gold may be one of the assets that rebound strongly if that transition begins. It is important to be clear here. None of this is a guarantee, and I am not telling anyone what they should buy or sell. But understanding how institutional investors interpret these signals helps explain why certain sectors suddenly start moving while others struggle. Markets are not driven only by headlines or emotional reactions. Large pools of capital follow patterns, and those patterns often repeat across decades. There is another area the report highlights that many people rarely think about during times like this: consumer discretionary stocks. The term sounds technical, but it simply refers to companies that sell products people want rather than products people absolutely need. Luxury brands, travel companies, restaurants, entertainment, and high-end retail all fall into this category. In other words, anything consumers can easily stop spending money on when economic uncertainty increases. Right now, these types of stocks are trading at levels we have not seen since extremely difficult periods like the global financial crisis and the pandemic shutdowns. That does not necessarily mean they will recover immediately, but it does indicate how negative investor sentiment has become toward those businesses. More than half of the companies in the consumer discretionary sector within the S&P 500 are currently trading at least 20% below their recent highs. Historically, when the sector reaches that level of pessimism, the following year has often produced a rebound. Not always, but frequently enough that professional investors pay attention to it. In fact, historical data shows that in similar situations, the sector recovered about 14% on average over the next year in the majority of cases. That pattern occurred 23 times out of 28 comparable periods, which is a fairly strong statistical signal, even though it is not perfect. The key point here is not that a rebound is guaranteed, but that extreme pessimism can sometimes create opportunities for contrarian investors who are willing to look beyond the immediate panic. However, for that rebound to happen, certain conditions need to improve. Financial conditions across the economy would need to loosen. That could involve global coordination to stabilize energy markets, lower borrowing costs, or at least prevent interest rates from rising further. It would also require credit markets to remain stable so businesses and consumers can continue accessing financing without severe restrictions. Without those improvements, the pressure on consumer-related industries could persist longer than investors expect. Beyond consumer discretionary companies, the Bank of America research note also mentions two additional sectors that large clients are watching closely. The first is software. Many software companies have experienced sharp declines recently as technology stocks corrected and investors rotated into other areas of the market. Some of these companies are now considered heavily oversold based on historical valuation metrics. If financial conditions improve even slightly, software could become one of the sectors that rebounds relatively quickly because demand for digital services continues growing long term. The second sector involves consumer finance. These are companies connected to lending, credit cards, payment systems, and financial services tied to everyday consumer activity. This group tends to benefit when interest rates eventually decline because borrowing becomes more affordable and spending activity increases again. If policymakers manage to stabilize the situation and ease financial pressure, consumer finance companies could also see renewed interest from investors searching for recovery opportunities. So what Bank of America is essentially outlining for its major clients is a potential strategy for navigating a crisis scenario. If policymakers intervene successfully and markets stabilize, certain beaten down sectors may experience strong rebounds while others lag behind. Institutional investors prepare for that possibility by tracking where money begins flowing before the recovery becomes obvious to the public. Now, whether or not you agree with that outlook, the important takeaway is that large investors are already thinking about what happens after the panic stage. Retail investors often focus only on the current drop in prices, while professional investors are studying the conditions that might signal the next phase of the cycle. That difference in perspective is one reason institutional capital tends to move earlier and more decisively during major market transitions. This brings us to a useful framework that helps explain where we are in the current cycle. My mentors used to emphasize frameworks constantly because they simplify complex market behavior into recognizable stages. Right now, several signals suggest we may already be in the early phase of a crisis pattern that has appeared before in financial history. The first signal is the oil spike itself, which has clearly occurred. The second signal is the volatility index, often called the fear index, moving above key levels that indicate rising stress among investors. That has also happened recently. The third signal involves risk assets falling quickly across multiple sectors, which we are seeing in both technology stocks and other major areas of the market. At the same time, financial media has shifted into constant coverage of uncertainty and geopolitical tension, amplifying fear across audiences. And finally, assets that usually provide safety, like gold, initially selling off along with everything else, is another sign often observed during the early stages of a broader market reset. When these signals appear together, history suggests markets may still be moving through the first phase of a larger adjustment process. That does not automatically mean a severe crash will follow, but it does indicate conditions where investors need to think carefully about risk management rather than reacting emotionally to every new headline. And this is where many retail investors make their biggest mistakes. When markets become volatile, people feel pressure to act quickly. Some panic sell near the bottom, while others chase assets that have already surged higher because they fear missing out. Both reactions can be costly, especially during geopolitical shocks where prices move rapidly in both directions. Historically, about 10 days after a major geopolitical event, the S&P 500 tends to fall somewhere between 5 and 7%. Then, over the following 12 months, markets often recover and move higher again. But that recovery requires patience and a time horizon long enough to endure the volatility along the way. Investors who panic early often miss the eventual rebound because they exit positions at the worst possible moment. That is why one of the hardest decisions during times like this is actually doing nothing. It sounds simple, but emotionally it can be extremely difficult. However, doing nothing does not mean ignoring risk. It means understanding where your exposure is and making sure you are not using leverage or taking positions that could force you out of the market if volatility increases further. Because once leverage enters the picture, even small market moves can create serious problems. Removing excessive leverage is often one of the first steps experienced investors take when uncertainty rises. They evaluate whether their portfolios could handle a 20 or 30% decline in certain sectors without forcing them to sell under pressure. And that question becomes especially important right now because unlike previous geopolitical shocks that faded quickly, this situation appears more structural in nature. The disruption to global energy supply is not something that automatically resolves within weeks. Facilities have been damaged, storage systems are affected, and even if the conflict ended tomorrow, it would still take time for normal production and distribution to return, which means assuming everything will bounce back quickly, just like previous short-term conflicts, could be a dangerous assumption. Markets often punish investors who rely on the phrase, "this time is different," without carefully examining the underlying conditions. So the real question becomes how to navigate the next phase of this cycle without making emotional decisions that could harm long-term results. Because there are certain sectors already performing well during this environment, while others are under pressure and may eventually recover later. And understanding that rotation between winners and losers is one of the most important skills investors can develop when markets enter periods like this. Now that we understand the broader patterns and early signals, let's talk about how money actually moves during these crises. Because here's the thing, markets are not random, they follow flows. Money is constantly rotating from one area to another, often before retail investors even notice. This is why institutional investors tend to outperform over the long term. They track capital movements, not headlines. In this situation, we are seeing exactly that. Oil is spiking, gold and silver have sold off, tech stocks are down, and consumer discretionary stocks are at historically low levels. But what does this really mean? It means there's a rotation underway, and history provides a playbook. When a crisis begins, retail investors panic. They sell everything indiscriminately. At the same time, professional investors start reallocating capital toward assets that will perform better when the dust settles. Let's break this rotation into phases. Phase one is the panic phase. That's where we are now. Everything seems to fall together. Safe havens, which you would normally expect to rise during turmoil, are dropping alongside riskier assets. This is forced selling, margin calls, portfolio rebalancing, and liquidity demands create indiscriminate downward pressure. Gold down 22%, silver down 44%. These aren't fundamentals. These are forced flows. The S&P has already lost a few percent in the first 10 days of the geopolitical shock. And remember, this is historically normal. Phase two is stabilization. This is where policymakers step in. As we discussed, Bank of America is floating the idea of a policy panic. That means governments and central banks intervene to prevent a total collapse. It could be as simple as bond buying programs, easing some financial conditions, or easing tariffs and geopolitical tensions. The goal is to provide liquidity and confidence. Historically, when this phase begins, capital starts rotating toward beaten down sectors: consumer discretionary, software, consumer finance, and certain commodity plays like gold. Phase three is opportunity. This is the phase most retail investors miss entirely. By the time the public realizes the market is rebounding, professional investors have already positioned themselves in sectors that benefit most from recovery. Consumer discretionary, for example, historically rallies after extreme pessimism. Software rebounds as tech markets stabilize, and consumer finance benefits when interest rates normalize or fall slightly. Gold typically regains its safe haven appeal as the dollar weakens during policy interventions. Here's an important point. Timing is everything. You don't want to chase spikes, and you don't want to sell during panic. Let me give you an example from history. In July 2008, oil surged from $55 to $147 in just a few months, right before the global financial crisis. The S&P fell 57% after that spike. Investors who chased energy stocks blindly or panicked during the initial sell-off lost significant amounts. Those who followed the flows and managed risk carefully survived the crash and capitalized on recovery phases. So, what does this mean for you right now? First, risk management must come first. Remove leverage, understand the maximum loss you can tolerate, and identify positions that could bankrupt you if the crisis worsens. That's not pessimism, it's smart preparation. Many people don't realize that avoiding catastrophic losses is just as important as finding gains. Second, follow the money, not the headlines. CNBC, Bloomberg, and mainstream media are reporting the shock, the chaos, and the panic, but they don't track the capital flows behind the scenes. Look at sectors where institutional investors are quietly positioning. Right now, that's software, consumer discretionary, consumer finance, and gold. But you don't blindly buy these sectors. You watch for when money begins flowing back in. This requires patience and observation. Third, understand the structural nature of this crisis. Unlike shorter-term geopolitical shocks, the disruption in oil supply is structural. The Strait of Hormuz is down roughly 70% of oil flow. Storage in certain countries is full. And physical oil in Asia is trading at $150 per barrel, far above paper prices in the US. This isn't going to snap back in a week. Investors need to account for longer-term implications on costs, inflation, and policy interventions. Fourth, consider the domino effect. Oil spikes affect transportation costs, which then hit producer costs, which eventually hit consumer prices. Inflation rises while growth slows. The Fed has limited options. Cutting rates risks worsening inflation, while hiking rates could crush the economy further. This stagflation scenario neutralizes traditional monetary policy tools, meaning the market will need alternative interventions like government stimulus or bond purchases to stabilize. Fifth, watch how the dollar reacts. A weaker dollar tends to benefit gold and international stocks. If the policy interventions are effective, capital will rotate out of the dollar and into assets that can preserve value. Gold historically rebounds during this phase, but timing is critical. Buying too early, during panic selling, risks further declines. Waiting for the flows to confirm is often the smarter move. Now, let's discuss contrarian opportunities. Extreme pessimism can create excellent entry points for patient investors. Consumer discretionary is historically oversold right now. Software and consumer finance are sensitive to financial condition improvements. Gold, after the initial forced sell-off, often finds renewed interest once dollar weakness returns. But these trades require discipline. You must be ready to act when flows begin to shift, not when the headlines make you emotional. Finally, consider policy impact and political credibility. If U.S. leadership struggles to manage the crisis, investor confidence declines. That affects market valuations and the strength of the dollar. Policymakers stepping in with emergency measures can reverse some of these effects, creating opportunity for those who anticipate the moves correctly. But misreading timing or structural impact could be costly. In summary, the current situation is complex but not chaotic if approached strategically. Recognize the phases: panic, stabilization, and opportunity. Focus on risk management first. Follow the money, not the headlines. Understand the structural drivers: oil supply, inflation, and policy limitations. Identify sectors positioned to benefit when capital flows rotate. And be prepared for patience. Market recovery takes time, and those who rush often lose. The key takeaway: this isn't about guessing the next headline. It's about studying patterns, tracking flows, and making disciplined moves when signals confirm. That's the professional playbook the Bank of America Research Note highlights for its clients. And while retail investors may not get direct access to those reports, the framework and historical patterns provide a way to navigate this storm with strategy rather than panic.